Do interest rates only represent figures on a screen, or do they have the ability to influence the structure of our entire economy? In a world where any change in interest rates has the potential to rock the financial system, it is critical to comprehend the complex dance that exists between these two indicators of economic health. However, what precisely do interest rate fluctuations entail for you and your financial assets? How do they affect inflation rates and the stock market, among other things? Come along as we solve the puzzles surrounding interest rates and reveal the secret factors influencing our financial environment. Prepare to explore the core of monetary policy in great detail and learn how it affects our financial destiny. In the field of economics, the Federal Reserve in the United States in particular has considerable influence on the path taken by financial markets and the overall economy. One such crucial choice is interest rate setting, which has a direct impact on borrowing costs, investment choices, and the state of the economy as a whole. There has been conjecture in recent years over the Federal Reserve's capacity to maintain elevated interest rates for a prolonged duration. Let's examine the reasoning behind this potential. Role of central banks. As the custodians of monetary policy, central banks have a tremendous impact on the economy since they set interest rates. Interest rates are one of the most potent instruments used by central banks, including the European Central Bank and the Federal Reserve in the United States, which are tasked with promoting sustainable economic growth and preserving price stability. The target interest rate, which is usually the federal funds rate, can be changed by central banks to affect borrowing rates across the board. Central banks may increase interest rates in an attempt to reduce inflationary pressures and discourage excessive borrowing and spending when the economy is overheating. On the other hand, central banks may cut interest rates to encourage borrowing and investment during times of economic weakness, so boosting economic activity. In addition, central banks are essential to financial stability since they oversee commercial banks and serve as lenders of last resort, protecting the integrity of the financial system. Central banks control liquidity in the banking system and guarantee the efficient operation of financial markets by supervising banks' reserve requirements and taking part in open market operations. Furthermore, central banks frequently use press conferences and public announcements to convey their monetary policy decisions, which influences investor mood and market expectations. In general, central banks play a crucial part in the global economic landscape due to their control over interest rates and their responsibility in preserving financial stability, which gives them enormous power over the economy. Immediate market response. Financial markets frequently react quickly and sharply to changes in interest rates. In example, stock markets frequently respond quickly to central bank announcements or signals pertaining to interest rate changes. Interest rate reductions are usually interpreted by investors as an indication of economic stimulation, which boosts confidence and drives up stock values. On the other hand, a rise in interest rates could be interpreted by investors as a harbinger of impending economic contraction, which would cause equities to decline as borrowing becomes more expensive and future profits are discounted at higher rates. This instantaneous market reaction illustrates how interest rates are closely linked to investor mood and expectations for the state of the economy going forward, underscoring the critical role that monetary policy plays in influencing market dynamics. Federal funds rate. One of the most important tools in the U.S. Federal Reserve's monetary policy toolbox is the federal funds rate, which it sets. In order to meet reserve requirements, depository institutions, including banks, lend and borrow money from one another overnight at this interest rate. This rate influences the cost of borrowing for consumers, companies, and financial institutions equally, and it is a major factor in determining short-term interest rates throughout the economy. In order to fulfill their dual mandates of maintaining price stability and maximizing sustainable employment, central banks modify the federal funds rate. In order to stop excessive borrowing and spending and stop inflation from getting out of hand when the economy is overheating and inflationary pressures are rising, the Federal Reserve may decide to raise the federal funds rate. On the other hand, the Federal Reserve may decide to cut the federal funds rate in times of economic weakness or recession in order to encourage borrowing and investment, which will increase economic activity and employment. Furthermore, the federal funds rate affects borrowing costs directly but also has far-reaching effects. It acts as a benchmark for a number of financial products and markets, impacting credit card APRs, mortgage rates, and short-term bond yields. A shift in the federal funds rate has the potential to impact the whole financial system, including asset prices, investor mood, and general economic circumstances. Because of this, the Federal Reserve keeps a close eye on market conditions and economic data when deciding how to change the federal funds rate. They understand that this rate plays a crucial role in determining the direction of the economy. Impact on borrowing and spending. Interest rate changes, especially those affecting the federal funds rate, which is determined by central banks such as the Federal Reserve, have a big effect on how much money people borrow and spend in the economy. Lessen interest rates make borrowing more affordable since they lessen the cost of getting credit. This encourages people and companies to benefit from cheaper borrowing rates, which raises expenditure on expensive goods like homes, vehicles, and company investments. Reduced interest rates encourage people to borrow money and use credit cards for luxuries, which boosts the economy even more. Reduced borrowing rates also incentivize companies to spend money on innovation and expansion, which boosts the economy and creates jobs. On the other hand, higher interest rates make borrowing more costly, which reduces expenditure by both consumers and businesses. Increased interest rates make it more expensive for people and businesses to borrow money since they result in increased monthly payments for credit cards, mortgages, and vehicle loans. As a result, companies may postpone or reduce investment projects, while consumers may reduce discretionary expenditure. During times of prolonged interest rate hikes, this decrease in investment and spending may cause the economy to grow more slowly and even cause the economy to decline. All things considered, the way that interest rates affect borrowing and spending patterns is a major factor in determining how the economy develops. Inflation management. Interest rate fluctuations are a crucial instrument used by central banks, such as the Federal Reserve, to control inflation in the economy. Central banks may decide to boost interest rates in an effort to curb investment and expenditure when inflationary pressures start to increase and pose a threat to buying power and economic stability. Higher interest rates reduce demand-side inflationary pressures by raising the cost of borrowing. This deters excessive borrowing and spending. On the other hand, central banks may cut interest rates to encourage borrowing and spending during times of economic weakness or deflationary threats, which would increase demand and inflation. Central banks strive to accomplish their inflation targets, which are usually set at about 2%, while upholding general economic stability and encouraging sustainable growth through carefully calibrated adjustments to interest rates. Effect on stocks. The performance of the equity markets and stock prices can be greatly impacted by changes in interest rates. In general, central banks that lower interest rates do so to lower borrowing costs and boost economic activity, which boosts corporate profits and elevates market mood. As a result, when investors anticipate larger earnings and dividends from corporations, lower interest rates typically lead to higher stock prices. On the other hand, higher interest rates make borrowing more costly, which may lower expectations for business profits and economic expansion. Because investors discount future cash flows at higher rates when interest rates rise, this typically results in a revaluation of the fundamental value of equities and a decline in stock prices. But since they may charge more for lending, some industries, like financial institutions, might profit from higher interest rates, possibly offsetting the negative effects on other industries. Although the relationship between interest rates and stock prices is complicated overall, shifts in interest rates frequently have a big impact on the mood of investors and the dynamics of the market. Investor decision-making. Interest rate fluctuations have a big impact on how investors make decisions about a variety of asset classes. Investors frequently look for larger returns on their investments when central banks cut interest rates because fixed income products like bonds and savings accounts have lower yields. Because of this, people might move their money to riskier investments like stocks, real estate, and commodities in an effort to increase their potential profits. On the other hand, as yields on fixed income investments rise in response to an increase in interest rates, investors reallocate their portfolios to include bonds and other interest-bearing assets. Changes in interest rates can also have an effect on exchange rates and currency values, which can have an influence on foreign investments and diversification plans. All things considered, investors must comprehend how shifting interest rates affect asset allocation and investment returns in order to successfully navigate the financial markets and maximize portfolio performance. The complex interplay between interest rates and the overall economy highlights how important monetary policy is in determining investor behavior and market dynamics. Interest rate changes, especially those imposed by central banks such as the Federal Reserve, had a significant impact on borrowing costs, inflation, consumer spending, and asset values, among other areas. Higher interest rates may result in decreased investment and spending, which could impede economic growth and stock market performance. Conversely, lower interest rates usually encourage economic activity and raise stock prices. Changes in interest rates also have an impact on investor decision-making, which affects asset allocation plans and portfolio performance. All things considered, in order to successfully manage the complexity of the financial landscape and pursue their economic goals, firms, policymakers, and investors alike must remain aware about the ramifications of interest rate swings. Unlock the secrets behind interest rates and discover how they shape our financial world. Subscribe now for exclusive insights and analysis on the impact of interest rate changes on markets, investments, and the economy.